Welcome back to episode 2 of the Daily Dip. Today we've got a packed episode all on swing trades, how to use indicators and time frames to enter them, and what to do if they're down 10%. We've also got Gary Trades talking about GRNQ, and to finish it off, we've got a little bit of chart analysis. So let's get it.
Another episode of the Daily Dip. Dan, thanks for having me. Pleasure like usual, brother. Today we're going to talk about stops and how to secure and maximize profits. Whether you're doing a day trade, whether you're doing a swing trade. This is a method I tend to use. I don't use it all the time. I mainly use this in day trades. It's called the creeping stop method. So before I enter a trade, I look at what my price target would potentially be for that trade. So let's say today I didn't trade this, but a lot of people did. GRNQ. Let's say today you bought in, let's call it 130. So you buy in at 130, price quickly increases to 140. Okay, so you're up a little bit. We start checking where's the support, where's the resistance. We use price action, we use the charts, and we also use the level 2, which is crucial. So I see where the biggest walls are, where the biggest asks are. I see where the biggest bids are. That is my support. So as the price increases, let's say it gets to 150, 152, let's say, I start to look at the level 2. Okay, where are the biggest bids? Let's say the biggest bid is at 145. That's a good level of support. I bought it in the 130. So I put my stop just under that support. Why do I do that? Because if it hits the support and does a reversal, bounces off, I'm good. I didn't get stopped out. But if it breaks through that support, I can be one of the first to sell. So in this case, I would put maybe my stop at 142, 141. I'm still securing profits there, but let's say it goes up further. So now it goes up to the 161 range. I check the level 2. I'm looking at the chart. I see, okay, the biggest support is in the 151 range. So at the 151 range, I'm putting my stop just under. I put it at 149. And as the price keeps increasing, I keep raising my stop price. So that is going to secure my profits as well as give me a good risk management. So at this point, I'm risking about 10 cents, but the ball is already in my court because I bought it at 130. You know what? I can play this one. We'll stay at 152. If it keeps increasing, great. If it breaks through the support, we can see more downtrend. I want to get stopped out. I will maybe re-enter the trade or just evaluate where the next level of support is and maybe put my buy order there. So this is just a little quick method that I use. It's creeping stops. And that's all we got for today. Thanks for having me, Dan. I wish you guys all the best on your trading. God bless.
All right, what's up, guys? So first off, I would like to say thanks to Dan and Hugh for having me on the podcast today. So it is August 18th, 2020. And what I see in the market today is outside of GRNQ, then we really haven't had that many opportunities for really good trades for intraday day trades. So GRNQ was a nice mover. It ran 300% today, which in August, anything that runs 300% is amazing. So that was nice for intraday scalps. It gave multiple entries. Just looking at the chart, if you were playing it, which I day traded this in and out several times. And as a day trader, that is something that you do have the availability to do. Now, I know a lot of you guys listening are probably below PDT and you can't really active day trade everything. But for those who can, then this provided several opportunities for you to scalp it today. Outside of GRNQ, there wasn't that many stocks that had a lot of volume. So on days like today, what you really want to be looking at is if there's no volume and you're strictly trying to day trade, then you might want to sit on the sidelines. Now, today was a good day to add to some swing positions that you might already have open or start a new swing position. For instance, I started a swing position in IMRN. Looking at the daily chart, it was just at a really, really low level right there with low risk from those 1030s ads. Now, looking at the daily chart, combine that with catalysts that they have a filing for a patent that could literally drop a PR any given time. So for me, not much going on intraday. It was a great time to add to that swing. We came up, touched 1150 resistance, and we're just kind of chilling around 11 right now. Now also, I want to touch real quick on this. So as a day trader, this is what you guys really need to drill home. The difference between a day trader and an investor is, as a day trader, you are not obligated or you don't have to be in a trade on any given day. So on a day like today, if your criteria is not there, if you're trying to force something, you don't have to trade. You have zero market exposure as a day trader until you click the buy button. So sometimes the best play is to just sit on the sidelines, wait until the next day when a better opportunity shows itself. And that's a really big advantage that day traders have over investors. Alright guys, so that's it for me. That's how I saw the market today. Not much outside of GRNQ. A great time to add to some swing positions or start new swing positions. And remember the difference between a trader and an investor. And make sure you're taking advantage of that difference that we have, guys.
Question is what do you do if a stock is down 10% from your original entry? So if you've ever heard that term, know what you own, it is used in times like this. Sometimes when a trader lacks confidence in their swing, they're going to freak out, they're going to panic sell on strong dips and have weak hands, if you will. When a trader has done the DD and is confident, a dip many times is nothing, and a lot of the times it's really a blessing. It's very easy to tell who has done their DD and who hasn't based on the reaction to dips. Me personally, I always like to have some cash at the ready to take advantage of situations to get cheapies, cheap shares, if you will. You've heard the term scaling in, you've heard the term buy the dip. So an example, let's say you plan on investing $1,500 into a swing. You've done the homework, you've done the DD, you're going to take a position. Take the $1,500 and divide it by 3. Some people do this 40, 30, 30. You know, for this example, it's divided by 3. So you'd take 500 for your starter. You'd take another 500 and buy more if it dips by 5 percentage points or a few percentage points. And then you'll take another 500 and buy more if it dips down to that 10%. You'll learn the personality of the ticker, so you can, get better at judging this after watching that ticker for a bit. But with this method, if the ticker is down 10% from your original entry, you're still in a great position to capitalize and make some money. All right, cheers. Be well. Kenny F. Powers.
What time frame on a chart do you look at for swing trades? What indicators do you use for timing and entry? So my absolute favorite time chart is the 180-day 4-hour chart. And the reason I like that is because I feel like it's not too far out to where I'm drawing, super specific resistance lines from far out, but then in the same token, it's not so close to where I can get a pretty good adjustment of where the trend line is going to be. And that's just my personal preference, but that doesn't mean that it has to be yours. I also like the 1 year, 1 day chart, and and that just gives me like a clearer sense without being too broad of a range. Now, if I really think that something so say we're looking at the 180-day chart and it's about to break out to an all-time new high on the 180-day chart, then that's when I might go to the 3-year, 1 week chart. And that's just so that I can kind of see like, there's not much data there for me to see. So by going to the 3-year chart, I can see at least some kind of trend line of where we might see a resistance or a support in the same token. And to follow that up with indicators, I do have RSI on, but that's not like an end-all be-all. That just kind of gives me like a little bit of a idea of, if it is, it's just like more of like a confirmation indicator for me than using it as an end-all be-all. I don't use MACD. I use VWAP, but I really don't use indicators because I do my own charting. So I use RSI, but I really only use VWAP for indicators. And what I'll do is that depending on the catalyst, and this is where you have to become a trader, depending on the catalyst is when I'll decide if I'm going to take a starter or not, right where it is, or if the chart is looking like a little bearish, like EVFM was 2 weeks ago, then I'll wait to see what it does, take a small starter, and then wait to see if it comes down to support, and then that's when I add a chunk. Or if it's coming towards resistance, I'll add a starter, but then wait for it to get through that resistance to double up my position.
Hey guys, Mr. Prez here. We're going to take a quick look on what happened today with Amazon and how it affected the options chain. So I trade mostly options, and the whole basis idea behind options is you want to get in when the volatility is low, when price action is coiling and consolidating, getting the implied volatility to a lower value, because when your implied volatility is low, your premiums are low, and when volatility is high, your Vega increases, which makes your volatility increase, which makes the price of the premium also go up. So I don't ever trade options without looking at the VIX, the volatility index. It basically just shows you the put buying ratio to calls, the put to call ratio. And you can see that every time we get into this COVID gap that was created during the March crash, we can't quite get below this green body right here. So that's kind of telling me that if we bounce to this level, it'll correspond with us hitting all-time high on ES, and I think we could see a bounce on VIX and a move down on ES from there, and from all-time highs. So getting back to Amazon and the options chain, you have so the term is volatility contraction. When you have the volatility coiling contraction, it's all the same shit as long as you can train your eyes to see it. You have a symmetrical triangle, so you've got an even slope of your trend from both directions, which means there's no bias in either way. This could have gone up, this could have gone down just as easily as it went up. Every technical pattern has a technical entry. It's not just as soon as price crosses the pink line, obviously. Your technical entries are going to be the first pivot to the left of the breakout. And since I had this key level on Amazon already written out at 32.53, I decided to just use that as my pivot. Now, that still left like 70 points, 60-70 points of green into that trade. And if you check the options chain on Amazon, you could have bought a 3,500 call. Well, we'll use the 3,400 as an example. You could have bought 150 points out of the money, 250 points out of the money whenever this move started. And if you take a look at the price action chart for Amazon's 3,400 call, we'll see what the price change today was. And this is assuming, if you got in yesterday and caught this whole move even. So the contract today opened up at $365. So if you would have paid $365 at the high today, you would have sold it at $2,220. That's pretty crazy. And and if you, even more so, if you would have got in yesterday, the price of the premium before the volatility spike, before the big increase in the Vega, you could have paid as low as $208. So if you would have bought this on Monday, you could have made a 10-bagger, almost a 12-bagger probably, off of this play. $200 to $2,220, $365 to $2,220. Then options trading is all about getting that big move, those big volatile spikes up or down. That's this move down here. I gave Amazon an 800 point price target on the weekly. And the call that I bought, it was 2,500 at the time, and 2,450 actually. And the call that I bought was 3,000 strike. It cost $400. It hit 23 grand. Obviously, I didn't hold it the whole time because I suck. But it went from $400 to $23,000 in 6 weeks because of that nonstop volatility. And the funniest thing about options is that it expired 100 and completely percent worthless at $0. But yeah, to summarize, options, you want you want to get in on low volatility, and you want to sell into the volatility or sell into the strength to make those 500, 600%, 1,000% returns. You don't care about scalping each candle. That'll make you lose with options. Options is about patience. It's about discipline and volatility. Thanks for having me on this episode of the Daily Dip. Episode 2. Shout out Trend Spider for the free trial on the account today. Shout out Dan and Hugh. Hope you guys got a little bit out of this crash course. Hope it helped. See you later.